What are you hearing from your clients when it comes to their worries about the debt ceiling? What are they saying to you? What are you telling them?
This is the number one question that we're getting, concerns about this debt ceiling showdown. Congress has always ended up raising the debt ceiling. That's 21 times since 2000, despite each time being a headache. So the chance of default is very low. But for those investors who are worried about a hedging or worried about a negative outcome, there are a few ideas they may want to consider here for those doomsday preppers out there.
All right, so you have some ideas. I love this. You always come with great ideas, Jeff. You also have some what I'm going to call some Warren Buffett-inspired ideas. You're looking at Japan. So you gave me an ETF to look at. It's up so far this year about 12%. Why do you believe that Japan and equities in Japan have more room to run?
Yeah, so a U.S. default would likely challenge the safe haven status of the U.S. dollar and favor the yen, the other major safe haven currency in the world. A default might spur investors to seek protection in Japanese stocks and bonds. Japanese stocks outperformed U.S. stocks last year and are actually ahead this year as well, and they posted a gain last night along with the yen. Japanese stocks trade at a forward PE of just 13 times compared to 18 times for the U.S. S&P 500. So they're already pricing in a bit more of a pessimistic outlook regarding the global economy. But I think investors could find value there in addition to a safe haven if these concerns about the debt ceiling continue to grow.
Yeah, I think the concerns will continue to grow until we get a deal. So as you know, Jeff, we always ask, investors, strategists like yourself and other bright minds on Wall Street, a word that they believe describes the trading day ahead. With all this volatility and potential disruption, what's your WEX word of the day?
My word of the day is retail. Today's retail sales data in China and the U.S. are likely to show slowing momentum, at least outside of auto sales. China's data already this morning was softer than expected and showed a slowdown in momentum just 4 months after reopening. In the U.S., economists are expecting a gain of just 0.2% for the month when we take out autos and gasoline sales when that data comes out at 8:30. And of course, the retail sales data also sets the tone for the upcoming reports from Walmart and Target later this week. And all this follows Friday's University of Michigan consumer confidence numbers that were weaker than expected. We know consumer confidence drives 2/3 of the economy, and this slowdown isn't good news for those worried about a deeper economic downturn.
Yeah, when you're talking about the economic downturn, that might also hit some stocks that are reporting later, Walmart and Target, two other big retailers as well. In general, when you're looking for opportunities in the market today ahead of this big debt ceiling meeting, what areas are you looking at? What would you advise your clients to stay away from right now?
I think you want to stay away from those equities that are really focused on a return to zero interest rates, those that are real excited about the Fed cutting aggressively later this year. I know it may seem that if we go into a default, the Fed would cut rates. I'm not sure the process is that linear. Instead, I'd stay away from the tech sector and those high-flying liquidity-driven stocks. Focus on more quality equities. Think about stocks that have low price to cash flow ratios or high dividend yields. Those have outperformed last year. They're doing pretty well this year also. I think that focus on quality is very important in a very high volatility period, and concerns about how companies are funding themselves. Those companies with a lot of near-term cash flow don't have to go to the credit markets and borrow at these very high rates. They're funding themselves at the same rates they did last year, essentially out of their cash flow.
So one last thought. When you're talking about bonds as well, Jeff, are you looking at short-term or longer-term? We're hearing some different opinions when it comes to the duration that you want to invest when it comes to bonds.
You want to consider buying longer-term treasuries. Short-term treasuries could sell off. A similar scenario as 2011 may play out where the U.S. gets another downgrade. Long-term treasury bonds would probably rally on expectations that the withholding of funds to service government obligations would lead to a recession. But again, note that there's a whipsaw maybe from default to no default, and that could be very fast. Trading the default means to be very nimble here as you look at trading, particularly in the treasury market.